We have K. Harihar, who is Treasurer at FirstRand Bank, joining us on the show. Hari, to begin with, after last Tuesday's rate cut, is there still an expectation in the market that before the end of the year we will see another quarter-point cut?
Nobody has ruled out that possibility, but clearly the possibility is diminishing quite a bit. They're looking at what the governor said and what's happening in the market. What the governor clearly said is if the inflation trajectory continues to go lower, and they've also given an indication of what the target they are looking at, then probably that will give them the space to do so. Now, clearly, while there's a clear target and a way to achieve it, the fact that the diesel price has been deregulated for at least the bulk supplies clearly shows that there is going to be a massive pass-through that's going to happen. Now, whether it will happen in the next couple of weeks or it will be a bit more stretched out, one doesn't know. But the inflationary numbers are going to look a bit higher after they go a little bit softer. So that is limiting the space for any rate cut and definitely for any pass-through from that. Separately, we all know statistically that the deposit growth has been very, very anemic. So even if there was a possibility of a rate cut, the ability of that rate cut to be passed through on the deposit side and therefore on the advances side is fairly limited, considering the run-up to March has always been a tight one. We are walking in with a deficit situation of about 1 lakh crore plus. And we are already seeing the banking system losing deposits to the alternate mechanisms of saving like mutual funds. So I would not rule it out, but I would say the possibility is very distant.
Hari, afternoon. If you could just tell us what your outlook is for the bond yields, because they have risen on comments from the RBI Deputy Governor, who has said that in fact they are looking to cut the held to maturity or HTM ratio for banks, and also said that they will be looking at OMOs in the month of February. How would you respond to that?
Okay, the second one first. When the CRR cut was announced, people should have rejoiced, but the sense in the market was there might be a proportionate cut in the OMOs, and therefore the market did not see it from a liquidity point of view as a net infusion of 18,000 crores, as much as profitability going up because the CRR did have a cost, but not necessarily liquidity. So this is a fairly comforting statement that the OMO window is still open, though they may not announce a calendar. And this is fairly needed because you have disinvestments which are going to happen, which have already begun to happen, and that will pull out the money. And in the month of March, you have both the tax payments which are due, as well as a calendar for the telecom second auction. So, the market's going to lose a fair amount of money. As far as the held to maturity is concerned, well, the talk has been there in the market that this is going to come about. And this is actually good accounting because you need banks to start marking to market as much of their portfolio as possible. And when the interest rates are down, it is actually the best time to probably reduce the space, because when they transfer it out of the portfolio, you're not going to have a mark to market. So at this point in time, I think a reduction the timing is perfect, but it will expose banks to volatility of income statements as, when the interest rates climb. Then what will happen is when you have a mark to market and you have a long duration portfolio, you could take a bit of a pain on that. But for the time being, I think it's a welcome move because it aligns India to the overall way accounting is looked at globally.
But Hari, from now until the end of June, there is this compulsion on a number of corporates to get their shareholding, promoter shareholding down to SEBI's prescribed levels. Do you worry that with these numerous issues coming to market, the deposit growth picture for banks is going to get a further hit, and possibly liquidity in the system is also going to take a hit on account of that?
Yes, it's a very real worry because, that's one part of the market which we have not been, looking at very carefully. And it has to be contextualized also in the backdrop of the fact that the CPI, the retail price inflation, has been high. Typically, if the retail price inflation had been lower, then the deposits would have accreted to the banking system any which way. But in a context where you had the stock markets looking reasonably strong, you had the kind of delistings that could happen, further issues that could happen, and a whole lot of queues that's going to happen. Now, if you were an MNC, you could look at delisting the share as an option, but if you are a PSU, then obviously selling further by way of a OFS or a public issue is probably the only alternative. So we are seeing a fair amount of money going out of the system. system. Separately, we are also seeing discipline that's come about in making sure that the 5.3% fiscal deficit number is met. And that's going to be met primarily by cutting the expenditure, depending on who you speak to, from anything from 50,000 crores to a lakh crore. Now, that's a serious amount of money. So that's very laudable from a fiscal point of view, but very negative to the market because that much of money is not going to be spent. So we are overall seeing a tightness in the system, and you see advanced numbers in the form of CD rates, which were about 865 for the 1 year sector just before the policy. They've already been dealt at 905, 910. And you could see the CD rates and the commercial paper rates being more elastic and going up to at least the base rate in the case of commercial paper and probably thereabouts in the case of CDs. I don't see, even if a rate cut happens, any immediate relaxation there. And we probably have to get out to April when you see more peace. Having said that, it's all negative. Globally, you see QE3 being extended. The last FOMC clearly says that unemployment is still there. You see Japan on a liquidity infusing kind of situation, so you see a lot of carry trade happening. So long as the stock market and the debt markets continue to attract the $4 billion equity, $4 billion coming in, I think you are in some semblance of balance, but you see a little bit of yield going up.
Hari, a quick word on the rupee.
Well, the rupee, I think I've been fairly bullish on the rupee, and I continue to be so. And you'll keep toggling between debt and equity. Equity has run up quite a bit, but I think given the fact that we have a 5 plus 5 billion extra announced for both corporate and government sector, and possibly also the fact that the rating downgrade possibility has gone down quite a bit, I think appetite for India paper in the context of a strengthening rupee is a virtuous cycle. So I think the rupee will continue to strengthen to maybe even 50 to 50 level. But the reality is also we have a trade deficit of anything from 15 to 20 billion a month, and that's not going to go away or get compensated by a larger capital inflow. So long as the net inflow continues to be negative, you'll see demand for dollars coming in. But I think up to 50 to 50 is a fair call.
Thanks very much, Hari, for taking the time out and joining in.